Hi everyone, we are Group 4. The company we choose is PETRONAS. This is our team member. Our group represents a strategic hedging analysis on PETRONAS Gas Berhad, which is one of the most important companies in Malaysia energy industry. First, let's look at why we choose this company. PETRONAS Gas Berhad plays a very important role in Malaysia's energy supply chain. The company not only sells gas, but it also manages a huge pipeline network of around 2,500 kilometers across the company. Their business includes gas processing, transportation, and regasification service. Besides that, the company also supplies important utilities such as steam and electricity to major petrochemical industries. Because of this, the company performance is strongly affected by the condition of the global energy and industrial markets. For this academic simulation, we are assuming that option trading is available for this stock. This helps us apply option strategy to manage the possible risks facing by the large utility and energy company like Petronas Gas Berhad. Now, let's look at the current market situation. The stock price is currently 17 ringgit 96 cents. Today, the price decreased slightly by 4 cents, or about 0.22%. Although the change is small, it shows that investors are being a little more careful and the stock is moving in a consolidation phase. This market condition makes it suitable for the option strategy that we will explain later.
Now, we will discuss on the current situation of the company. PETRONAS Gas is a defensive utility stock with very stable earning. Right now, it's just trading near the upper end of its historical price range and it has just recovered from a period where it was oversold. Next, we will discuss on the risk profile of the company. First, the volatility of the stock is low. The stock price moves slowly and rarely changes by more than 1 or 2% in a single day. This is typically for a utility company. Second, the stock has been range bound for several years, trading mostly between 16 ringgit and 19 ringgit. It does not break out strongly in either direction. Third, the downside risk of the stock is limited. Based on historical data, the stock has support around 17 ringgit and it rarely falls far between the level. Fourth, the upside potential is also limited in the near term. Analysts have a neutral rating on the stock with a target price only about 3 to 6% higher than the current price. Finally, Petronas Gas is in the gas processing and transmission business where its earnings are stable and regulated by the government. This makes it a defensive stock, which meaning that it performs steadily even during economic downturns. In the next slide, we will discuss on the strategic for the company.
Okay, now I will explain why we choose the bear put spread because Petronas Gas has a low volatility and a mean rebacking price pattern based on the historical data provided. So over more than 3 years, the stock price has remained within a small price range of around 16 to 19 ringgit with no sustained upward or downwards breakouts. Daily price movement are also very small, usually less than 1 to 2%. In this kind of market conditions, strategy that depends on large price movement, such as long straddle or strangle, are usually less effective because the price does not move enough to cover the option premiums. In conclusion, bear put spread perform better in stable market and more suitable because it profit from a moderate decline in price, which is more realistic for a defensive stock like Petronas Gas when it is trading near the upper end of its historical range. That's all from me.
PETRONAS Gas is currently trading near the top of its price range, around RM18, which suggests the stock may face resistance and experience a pullback toward the RM17 to 17.5 range. In this situation, the bear put spread is a suitable strategy because it benefits from a moderate decline in the stock price. Since PETRONAS Gas operates in a low volatility environment as a defensive utility stock, large price jumps are unlikely. This means investors do not need an expensive strategy that depends on a major market crash. Instead, the bear put spread is more cost effective because selling the low strike puts helps reduce the overall premium cost and improve the risk to reward ratio. In addition, the strategy has limited risk and limited profit, which matches the realistic movement of the stock. The cap profit is acceptable because Petronas Gas is not expected to fall sharply. Therefore, the bear put spread fits the company's stable market behavior and allow investors to profit from a controlled downward movement while keeping potential losses manageable. I will explain the strike price and premium estimates. The upper strike price, which is the buy put, is set at RM18. This is based on the current stock price and also act as a historical resistance level. It allows the option to gain value immediately if the stock price starts to fall. The lowest strike price, which is the sell put, is set at RM17. This is based on a strong historical support level, and it also helped reduce the total cost of the strategy. For the premiums, we estimated RM50 cents for the RM18 put and RM20 cents for the RM17 put. This results in a net cost of RM30 cents per share. Those values are reasonable because Petronas Gas is a low volatility stock where option prices are generally lower. Overall, the bear put spread is suitable because it works well in a low risk range bound market. It also allows us to profit from a moderate price decline, limits losses if the price increases, and is more cost effective compared to strategy designed for high volatility.
Next, I will explain the payoff calculation for the put spread strategy using put option. First, the assumptions are shown on the left. The current spot price is 18 ringgit. We will buy a put option with a strike price of 18 ringgit and pay a premium of 15 cents. At the same time, we will sell another put option with the strike price of 17 ringgit and receive premium of 20 cents. Therefore, the net premium paid is 13 cents. Next, the table shows the possible outcome at different future stock price. For example, when the future price is 16 ringgit, the long put give a payoff of 2 ringgit, while the short put give a loss of 1 ringgit. The result is in a net payoff 1 ringgit. After subtracting the premium cost, the net profit is 17 cents. As the future price increase, the payoff decrease. When the stock price reach 18 or higher, both options expire worthless, and the investor only lose the net premium of 30 cents. In conclusion, this strategy provides limited profit, limited loss, and making it accessible for investors who expect the stock price to stay stable or increase slightly.
This is the option strategy dashboard for Petronas. First, let's go to the option parameters. You can enter the value you want to generate here. This is the current stock price. For example, enter the value, then enter, it will calculate by itself. The strike price K1 is equal to the long put options, and its premium is 50 cents. For the strike price K2 is for the short put options, where its premium is 20 cents. And the time to maturity is in the unit of years, where 0.25 is equal to 3 months. Next, let's go to the option strategy results. The net premium is equal to the long put premium minus short put premium. The long put payoff is equal to the maximum value between K1 minus current stock price and 0. Then the short put payoff is equal to the negative maximum value between K2 minus current stock price and 0. And the total net payoff is equal to long put payoff plus short put payoff. And the total net profit or loss is equal to the total net payoff minus net premium. In our case, for the strike price that more than or equal to 18, our maximum loss is 30 cents. For example, I try 90, so it's still the same. And for the stock price who less than or equal to 17, for example, so our maximum profit is 70 cents. I try another value, 9, so it's still the same for the total profit. And the table below shows the total net profit or loss under a different stock price. And these are the graphs who represent the bear put spread net payoff, where the x-axis is equal to the stock price and y-axis is equal to the net profit or loss.
Now, let me explain the effectiveness of our bear put spread strategy. First, when does this strategy succeed? The strategy works best when the stock falls moderately, somewhere between RM17 and RM18. It also works if the stock stays flat or drifts slowly downward. And because Petronas gas has low volatility, this strategy fits the stock's behavior well. Now, what are the limitations? First, the profit is capped. You cannot make unlimited money even if the stock crash. Second, if the stock rises above 18, you lose the small premium or premium you paid. Third, you need to choose the strike price carefully. If they are too far apart or too close, the strategy may not work as expected. Finally, this strategy is not designed for a sharp crash. If the stock falls far below 17, you give up extra profit because of the sharp put. Finally, how would we adjust if the market view changes? If we become bullish, we call switch to a bull call spread. If we expect a sharp move but are unsure of the direction, we would use a straddle or strangle. If we already own the stock and just want protection, we would use a protective put instead. And if we expect the stock to stay completely flat, we might do nothing or sell a covered call. In summary, the bear put spread is effective for our current neutral to slightly bearish view on Petronas gas. It has limited risk, measures the stock's low volatility, and performs well during a moderate decline.
During this project, we faced several challenges in developing the bear put spread dashboard for PETRONAS gas. First, finding the realistic option premiums was difficult because PETRONAS gas options are not actively traded on Bursa Malaysia. Therefore, we had to estimate the premium based on stock volatility. Another challenge was choosing suitable strike price. We need to make the strategy realistic while also keeping the dashboard simple and easy to understand. In addition, building the interactive dashboard was technically challenging because all formulas and graphs had to update automatically. Whenever the inputs change, for future improvement, we would use actual option data from Bursa Malaysia to make the premiums more accurate and realistic. We would also include implied volatility in calculation instead of estimating premiums manually. Lastly, we would add different expiry periods such as 1 month, 6 months, and 1 year to better study how times affect the strategy's profit and loss.
Next part is conclusion. For this assignment, our group have decided to analyze PETRONAS Gas Berhad, a company with the low stock volatility due to its stable utility business. Based on the neutral to bearish market view, our group has decided to apply a bear put spread strategy where you will buy a put at a higher price and selling a put at a lower price to profit from moderate price decline with a low cost. Our dashboard simulation will be showing that this strategy is effective when the stock fall moderately because it offers low cost, defined risk, and a break-even point, but profit is capped and small loss occur if the stock rise. Through this process, we improve our understanding of option strategy for the low volatility stock. Even though there are challenges in estimating the premium, we learn to adapt financial tools to the real world problem.
These are the references that we mainly refer to complete the slide. And that's all from us. Thank you.